Hi, this is Roger Conrad. I'm editor of Canadian Edge. What I want to talk about today is some of the action that we've seen in the last few weeks after earnings particularly have been announced. A number of companies, starting with Pembina, but also companies like Bird Construction, have reacted very dramatically to earnings numbers that really, when you read over and look at the health of the underlying business, were fairly benign. But triggered some pretty massive reactions in the stock market. So why is this, and is this something we should be concerned about? Well, I think there are a couple of reasons. I think, number one, we've seen some pretty dramatic buying and some pretty dramatic increases in prices since the summer in a number of these companies. Part of that's the Canadian dollar, which has done well against the US dollar. But a lot of it is people coming into these stocks and realizing, hey, these yields are probably going to last past 2011, or at least they're going to be very competitive in 2011. And that's, of course, much different than the popular perception has been for the past 4 years. So we're getting some positive reaction there. We're getting some pretty strong profit results from various companies. So we have been seeing these prices go up. So then when you see that the earnings numbers come along, painting the same picture of a fairly stable company, typically the reaction in the market is buy on rumor, sell on news. So that's the news part, and we've seen these things sell off. That explains some of what we've seen, but I think probably more of why these reactions in some of these stocks have been so violent is because people are still putting on these trailing stop losses. Hopefully none of you were doing that with, say, Bird Construction in particular. This stock had gone well past our buy target and had been there for quite some time. These earnings came out. I think the company had basically been telegraphing that this would be the case. Earnings less than year-ago levels, less than what some had expected, primarily because they are getting lower margin contracts. That's how they've been able to maintain and expand their backlog through these difficult times. But the most important number for you as an income investor is, of course, dividend coverage, and that remained very solid. Company also affirmed its intention to convert to a corporation in January while maintaining the dividend at its current rate, taking it from monthly to quarterly, maintaining it at the same rate. So pretty benign news. Also, the company pointed to some developments that indicated much stronger sales sometime over the next year starting to kick in as the oil sands business and projects that had been talked about by various companies start to come to fruition. So there was actually a lot of good news in there, despite the headline number. The market reaction, though, took this thing down from the high 30s down actually at one point into the high 20s. So fairly dramatic move. It's since bounced, reclaimed about half of that loss actually in the same day. It's kind of stabilized where it is now. Again, this is a cautionary tale. Number one, it's a pretty good reason why you don't want to chase these things above our buy targets. And number two, it's a pretty good reason not to put in things like trailing stop losses. A lot of people, I'm fairly certain, put these things in when we got up to pretty high levels. When those levels were breached on this earnings news, again, buy on rumors, sell on news type of thing, but maybe a little bit disappointing. And all those sell orders came on the market at the same time. Bam, knock that stock down. If you were one of those people, you got taken out at a terrible price. So again, watch those buy targets, and don't try to game the system using these trailing stop losses. Let's just look at how the companies are doing, make our judgment on whether we want to own them long-term based on that. That's all I have to say today. We've, of course, continued to update the earnings of companies and in various flash alerts, and we'll be looking at these issues in more detail in the December issue as that comes out. Meantime, I invite you to look at the November issue, look at the various flash alerts we've sent out this week, and keep up with how your companies are doing. That's really what's going to determine how we do with our returns over the long haul. Thanks for tuning in. I'll look forward to chatting with you next time.